Yes. Hi,
There we go.
Carlos.
Hello.
Sergio, what did you do to our Zoom meetings? Carlos has showed up at Sergio too.
Yeah, I have superpowers, it seems.
That's all right. Well, I'm going to go ahead and we'll go ahead and get started.
Let's get
I
started.
wanted to introduce Ponce Financial Group, New York City-based thrift conversion. So you guys were in MHC. We heard from Mike Godby earlier in the day about MHCs, and then you did a second step just about a year ago, I think, a year ago and a little bit. You have a strong track record as management, and we'd love to hear about your initiatives and your thoughts on capital management. I just wanted to take a moment to, if Christine is, well, it will be in the chat box. There'll be a link to a PDF that I did with some valuation and operating metrics. And I just wanted to take just a quick moment to point out the different columns. There's the stated from the most recent quarter stated. I've also put in a column if you were to take away the last 2 quarters of negative AOCI marks. And then for Ponce, the third column is if you were to take away all of the exposure to grain technologies. And I know we're going to be talking about grain technologies, but this was a fintech experiment. And so I just wanted to show the numbers. If we were to completely exclude that, just write everything off in the worst case scenario. So I'm going to turn it over to you, Frank, and Sergio and Carlos, and I'm going to get your slides going just a second.
And just a reminder to all the attendees to ask questions, please use the Q&A chat box at the bottom of your screen, or raise your hand and we'll call on you. Thanks.
Yes.
Carlos, you want to take it off with a brief description of the board of directors, the executive management team?
Yeah, I will. And thank you all for having us participate. I just want to complete the capital picture that was described, and then I'll go into the management and the board. But we are a CDFI, that's a community development financial institution and a minority depository institution. And so on June 27th, we received from the United States Treasury Department under their ESIP BCIP program, $225 million in capital. So in addition to the 2 steps, and obviously our retained earnings since we were founded 60 years ago, we now have total capital of $520 million or so. And so, you know, our game plan obviously is to, as much as possible, to start deploying that capital. And in the meantime, we are trying to leverage that capital through investments, and you'll see that has increased significantly. But the bank was founded in 1960 in the Bronx, in a group of mostly Puerto Rican business people and community activists at the time that the Bronx was being abandoned and it was burning. And the mission of the bank was then to provide capital and banking services to the underserved communities of the Bronx. And that continues today under the tutelage of a board of directors that is comprised of minorities mostly and immigrants. We have a couple of first generation non-immigrants, the rest of all immigrants, and it is largely Latino, largely real estate professionals and investors. And the management team likewise is minority. Over 80% of our staff is minority. Latino and women are a significant majority of that majority. And today we have a management team that we have augmented significantly over the last 6 months to enable us to grow and deploy our capital. So in addition to myself and Frank, we now have Sergio Vaccaro that joined us as Frank moved over to focus exclusively on investor relations. Frank yielded the CFO position to Sergio. And then we also brought in Luis Gonzalez, that has 15 years plus experience in the OCC to be a chief operating officer, to really signal to both the bank and the investor group and regulators the seriousness with which we view regulatory compliance. And that has been a hallmark of my involvement in banking as a regulatory counsel for many institutions, including Ponce, starting way back in '84. And so we have augmented also the mid-level positions and some senior vice president positions, so that we are really geared to expand significantly the operations and influence of the bank. We have begun to be much more participatory in the regulatory, political, and industry world, and as we bring in folks to handle more of the day-to-day stuff, I've become members of various financial and industry groups, banking groups, including vice chairing minority depository councils for the Independent Community Bankers Association. I was just appointed to the New York Fed's advisory council, and I'm on an ABA committees, etc. Plus, being appointed to a couple of advisory groups by Governor Hochul in New York. So we are really beginning to be the go-to institution in terms of the minority and Latino markets in New York, and expanded our presence outside of New York in other communities that are underserved, but as we like to say. So that's a quick, overview of the institution and kind of a macro view of what we're trying to do, and obviously the challenges that we face as we move forward. Frank, you're the director of the presentation. What next?
Yeah, so Julian, if you can move down a couple slides, we don't have that much time. The slide deck is going to be a little bit too long to go through everything. Carlos actually touched on all of this one here in terms of the capital that we brought in. Go back to the other one, Julian, real quick on this one. The one with the bullet points with the blues. I think it's the previous one. Sorry, Julian, or the next one.
I apologize. Is that, so not this one with the bullet
Now
point?
go to the next one. Go,
This one.
yeah, right there, right there.
I apologize. Okay, thank you.
So, Carlos always talks about our strategies of focus, which we've been able to employ and deploy. And you moved on me. Okay. So two things that I do want to add additional color to what Carlos said here. Obviously, the multifamily non-residential, if you look at our numbers, you can see that's where our cup of tea is at, right? The next thing is the second bullet there, enhancing our leveraging of minority depository institution and certified depository financial institution, of which we're only one of 34 in the total bank space that have both designations. So that's a pretty strong statement. The last bullet on there, everything else comes along with the capital that we have, the capital that we have to deploy where we want to get to. The last bullet is enhancing our digital presence by delivering impactful services to our customers. I think that's very important. Quite frankly, if I was not a bank employee, I would not be stepping into the lobby of a bank at this point in time. So that's something that all of us have to focus on. We can go to the next slide.
Actually, let me, if I may, Frank, just add one little piece of it. No, that's fine. We talk about MDI and CD5 status. I think that obviously access to capital from Treasury, access to programs like the Emergency Response Program at Treasury funds and gives grants to institutions like us are very important. But also from a product perspective, under the exception to the Graham-Leach-Bliley Act, we are able to offer non-qualified mortgages. And those are mortgages that have much higher rates and are geared to the purchase and refinance of residential owner-occupied property by essentially self-employed and business owners. And that's a market that is thriving, particularly in the city. and allows us to get higher margins, serve communities that are otherwise not served because these people generally don't have the kind of financial statements and reports that are normally present when you're a W-2 earner. And the ability of us to meet those needs using the law that is provided under Graham-Leach-Bliley really helps us and our mortgage operations. Go ahead, Frank.
That's a good point. And then, and sorry, I broke up a little while ago. I couldn't hear some stuff, so if you said it, Carlos, I apologize. But under the MDI CDFI, we got, and you'll see this in a spreadsheet, in a graph here later. We got $1.8 million where we were able to offset some of our losses. You'll see that in a slide coming up later. And Carlos, I don't know if you mentioned, and I'm sorry if I missed it, but that 225 million that we got from Treasury is 0% for the next 2 years.
Is very low cost. The highest
Very low cost, yes.
the highest it can go is 200 basis points, and it's perpetual preferred.
Yes.
And so there's no need to repay it. And in fact, it can be used and obviously leveraged significantly. So if you just think about growing that 10 times the capital it brought us, it's significant ability for us to deploy more lending.
Right. All right, so we talked about this slide, MDI, CDFI. Let's see what's, as a CDFI, and I'll just touch on this briefly here. I think one of the two things, if you look at the first and third bullet, out of the 20 largest CDFI banks in the country, which are 184 of them, we're first in housing focused, which are the two highlighted bullets there, right? That's part of our CDFI MDI mission, making an impact in our community. Okay. Next slide. Carlos, anything else you want to add on it?
No, that's good.
On this slide here, so I went back. What I wanted to try to demonstrate here is the first graph all the way to the left, where it says 800 million. That's 2017 Q3. It took this organization 60 years to get to about the $800 million mark, if you will, or north of 800 million. 60 years. Fast forward to the second quarter of 2022, we've pretty much tripled the size with the capital that we've gotten and the capital that we've been able to raise. Same thing for the loan portfolio. If you look all the way to the left, if you look at the loans where we were at back in third quarter of 2017 and where we're at today, some of the shrinkage and some of the flatlining that you see in the loans obviously have to do with the PPP loan portfolio, right? We originated more than $200 million in PPP loans. Currently, as of the second quarter, we're only at 30.8 million. So some of that shrinkage is going to be reflected on the balance sheet part of the loan side, okay? Securities, big increase there. Carlos actually talked about this earlier. It's going to take us some time to deploy the 30% plus capital, regulatory capital that we have. So one of our new initiatives is to deploy the initial capital into the securities portfolio while staying short. And you'll see, I mean, you can see from the second quarter filings, a lot of this is in agencies, pretty safe bets, if you will. But there is, if you look, there is some corporate debt. The corporate debt, just to make it clear, is all in banks. Banks that we know, banks that we can study, banks that Sergio, Carlos, and I can look at and say, this is a good bet, right? In other words, we're not getting into Ford and GM and stuff like that, okay? So we feel pretty comfortable with that. If you go to the bottom quadrant there, total deposits, that's a function, and Julian, I think you and I may have talked about this. The total deposits is a function of where we want to maintain a loan to deposits ratio, right? We like to operate in the 115, 125% range, right? So that's a function of that.
Yeah, Frank, the point that I would also make in the total deposits is that on the conversion side of the house, the
Right.
deposits converted to equity, and then as the Fed gave us 225 million, that was cash. So our immediate need for deposits and funding decreased somewhat, and that's why you see that decrease.
Yeah.
And in today's environment, we also pick up money, that is the cheapest and most effective for us, given our asset liability mix. Go ahead, Frank.
And this all these graphs here are representation into our net interest margin, which should be the next sheet. Yeah. So the net interest margin, and when I say representation of this, that second, first quarter, if you look at it, it was above 450. We're still above 4%, which is still well above our peers, right? Two things that play into that again is the payoffs from Treasury in terms of our PPP loans, right? There's two sides of that equation. One of them is the deferred loan origination fees that went into that, as well as the interest income that you immediately recognize once you forgive those loans. So they kind of offset each other. But if you take away the fourth quarter and the first quarter, we're pretty much in line with where we've been projecting. And if you look at our peer group, we're still in the 90th percentile in terms of our net interest margin. We've got two outliers there, and it's that fourth quarter and the first quarter of last year.
Oh,
go ahead.
The other point I would make here in the net interest margin is that you would expect a decline in the margin as we increase the securities portfolio. That obviously has a lot narrower margin that our loans do when funded, by deposits. So that the dollars of net interest income are obviously increased, but from a percentage, as you look at it there, you would expect a decline given the securities portfolio that we are deploying. Thank you, Frank.
Yeah, but overall, if you look at our 10Q, I mean, you'll see that our interest rate spread as of the second quarter has improved. Our cost of funds has declined. We're in a different environment today, so don't quote me on this, but we know where rates are going. We know that the Fed is meeting. We know where inflation is at. We know what's going to happen going forward. So there is going to be some compression, right? And that's to Carlos' comments between the strategy of putting more funds, initial funds into the investment portfolio. With a rising rate environment, there is going to be some compression. However, what I do want to point out to the group here is over 90%, if not more, and Carlos or Sergio, correct me, I don't know the number. Most of our loans are adjustable rate loans, okay? So as rates go up, as loans come due, we're going to see the offset to the compression from the deposit liability side. We're going to see some offset on that, okay? Loans to deposits, we talked about. Efficiency ratio, I love this ratio, and Carlos always gets on to me because I talk about this ratio so much, but this ratio is a little bit, there's a lot of noise in here because of what happened in 2021 when we did the sale leaseback transactions. So there's some noise in there. There's also some noise in the first quarter because of the foundation gift that we did, or foundation donation, I shouldn't say gift. I guess it's the same thing. And the expenses associated with going public. So there's a lot of noise with the efficiency ratio. As I tell the management team here, you always have to look behind the curtains when you look at this type of number here, or this type of ratio. Okay. Our goal is to get to 60, 65%. Okay. Any questions? All right. Julian, I don't know how much time we have. Okay, so available for sale securities, we talked about this. If you look at the total available for sale securities here, Our fair value at year end 2021 was 113. That increased, I don't want to say slightly, but it went up to 158. The big number here, and Carlos talked about this earlier, is the bottom line number there, where most of our securities that were purchased, they went from 914,000 to 211 million. So that was a lot of effort of putting some money to work for the organization until we can deploy these monies into loans. All of these securities, the majority, I shouldn't say all, the majority of the securities cash flow quite a bit every month, allowing us to continue to deploy those cash flows back into the loan portfolio, which is the highest interest earning asset that we have. Okay, so we did that for two reasons. One, the held to maturities portfolio, while you see there that more than 5 years to the 10 years, about, bless you. You know, it's a higher number than, sorry, 1 year through 5 years is 75 million. More than 5 years through 10 years is 4 million. The point there is that our goal is to maintain the duration of the investment portfolio to 5 years or less. So that's one of our principal goals when it comes to the investment portfolio. But I want to go back to something Carlos said earlier. You will see some compression because the spread on this investment that we're making is not going to be as great as it is when you're putting all this money to the loan portfolio. Carlos, anything else on the investments? Because these are big numbers for us.
No, I mean, we have, just so we understand, we put in very robust internal controls and investment targets and have the active involvement of board on every one of those things. So we make sure that we are very conservative in what we do and also mindful that we want to get a spread because this is leveraging the capital for the benefit of our stakeholders.
A lot, Frank, we have several questions and we have less than 10 minutes. Is it all right to start the Q&A? And I'll just start along what you just said about the capital. You have lots of capital to deploy. The grain technologies, there's some remaining exposure.
Can you go to that slide while we're talking about this? Yes. Please.
Yeah, can you tell me?
I think it's page 17, 16 or 17. Because I think that's important that we bring that up.
Okay, Frank, why don't you go ahead and walk us? Oh, not this slide though. I'm sorry.
No.
Let me.
It's page.
I think on the grain
15.
technology, while you're looking.
16, yeah, page 16, number 16.
I apologize. There we go.
There we go.
Okay, let's talk. Yeah, let's talk about this, and then we have some questions on it.
Okay, so I could talk about this really quick, and then Carlos, Sergio, you can add in. I know we're running out of time. So on the 10Q, that top graph that you see up there with the 30.899, that's our total exposure. That doesn't mean that we're going to lose all that money. That's our total exposure. You could go down the rows there and tell what our exposure is. I think more importantly here, and I really wanted to make a big statement on this one. If you look at our tangible book value as of 6/30, we stand at 11.85, right? 11.85 per book value. Stock price as of yesterday closed at 9.50. So you take away this exposure, you're still dealing with a pretty good price to tangible book value, right? Okay, go down to the bottom graph where we stress this at 25, 50, 75, 100%. I'm not saying that either of these scenarios are going to materialize. This is just for the benefit of everybody on the call. So if we focus on the 50%, for example, right, the 50% column, after tax stress losses would be 12 million bucks. Our book value per share would decrease from 11.85 to 11.37, right? You still, if you buy into this at that point in time, you're still buying in at a discount to tangible book value, even with a 50% loss. When we look at our peer groups that currently are trading at 110, 115 as a percent of book value, We see a lot of value in this stock, and I'm not giving advice to anybody. I'm just talking about myself. We still see a lot of value in this stock. Aside from grain, another point I want to make is that 30 million is only a small 2 decimals of what we have in our entire portfolio, right? Our portfolio at 1.2, 1.3 billion, this is a small piece of it. If you look at the rest of that portfolio, how it's performed in the past, the charge-offs that we've had, the provisions that we have, the allowance that we have to the total portfolio. To use one of our analysts' words, and Julianne, you've heard me, the rest of our portfolio is pretty much pristine.
Right. Yeah, I'd like to just clarify that. So this grain technologies exposure was pretty ring fenced. It was completely separate from the rest of the loan portfolio.
Yes.
Deposit, where it's completely ring fenced. And is it, you haven't announced will it have any impact on share repurchases, will it have any impact on capital management decisions at all?
No,
Carlos, you want to talk about that one?
It would not have any impact on those kinds of decisions. So we're comfortable with our capital management program, and as you know, we prohibited from doing any share repurchases, et cetera, in the first 12 months, and the Fed has a track record of not approving that, and we are shortly going to have the whole year behind us. So
Right.
we
Right.
Yeah.
Right. Okay, good. So let's see if we can just go to questions right now. We have a question about using the ECIP funds to make low doc, no doc loans, potentially going into a recession, and who bears the loss if the Treasury were to call back their 225 million stock.
Well, so that let me pick up the last part of your question. There is no reclamation provisions
Okay.
in the legislation. Treasury does not have the authority to come back and say, hey, give us the 225. In fact, there's a provision in the law that says that we, the bank, can apply to Treasury to transfer the securities, the preferred stock ownership, to a affiliated nonprofit organization of the bank. And as you know, we have the Ponce Financial Foundation. So, that is a clear indication that that whole program is perpetual, and it's geared to helping the communities, and we have stated that we'll take advantage of that provision to pass on the payments that we make to Treasury in the future, pass it to our community through our foundation.
Okay. All right. We have a question from caller from Kenchi.
Do you guys hear me?
Yes.
Yes, Henry, how are you?
I'm well, and I hope you are too. So I appreciate that chart that you just put out. If you were to take a 25% hit, 50, 75, 100. The problem is if you keep grain on your books, the charges could even be even greater. If you continue to lend, who knows? So my point to you is, if you want to close the gap between you and your competitors, I would highly encourage you to sell it, no matter what the loss is. Just get rid of it. I think as long as you have this on your books, there's going to be this overhang.
Well, as you know, we have announced we are not extending any further lending in the program, and we are.
I thought you're still extending to those customers that have loans, and so if they can't pay back their $50, you're giving them another 50 to extend, right? I mean, it's
No, we're not doing that. If they pay back the $50 and then they want another $50, then we will lend them that $50. Remember that there is lender liability issues and all kinds of compliance issues when you pull those kinds of lending programs from people. And so, we are diligently looking at all the alternatives we have, not just from a pure portfolio and collection from grain itself, but also, all of the legal and compliance requirements that exist in us doing anything like that. And so, you know, we are very comfortable that we are getting a handle of it, and we look forward to doing a finalization of this whole thing. So.
Yeah, and just one other, Julian, can I just jump in? So
Yeah.
look, again, you know, I know you can't talk about what you're doing, so I'm not gonna push you on that. I would highly encourage you to just really get rid of it, get rid of your book. Now, you've got all this money from ESIP, et cetera, from the money that you're raising the conversion. Are you gonna go into other lines of businesses that are not your core? You know, like you said, credit quality has been pristine on the things you historically lent on. And so are you going to get into other lines of businesses, dabble again in things that are not things that you did in the past?
Well, I think that you have to move the bank forward as the industry moves forward, and digitalizing a lot of the things that we do and automating a lot of things that we do are imperative. I think expanding of our 1 to 4 family and sales to the secondary markets are important. Those are all things that you need to be done. We're not going to remain a you know, static institution, because that's not going to serve anybody well. And we still take very seriously our obligations to serve our community and all of our other stakeholders. And
Yeah,
all of which,
I mean, you know, fintech, things like that. I mean, I'm not talking about things that you've done. 1 to 4 family sounds like something you've done. I'm talking about other lines of businesses. I don't know.
well, I mean, look, you can't avoid technology. So to say that we would not do any fintech stuff, I think that's a mistake. I mean, if a fintech can deliver to us transaction processing at a fifth of the cost of the legacy core providers do, I'd be crazy not to do that. And so I think it's the judicious deployment of the technology and services, you know, and keeping up with the Joneses, you know, the cities and the Wells Fargos and the Capital Ones in our market is very important. And so, you know, I don't want people to believe that we're going to remain a static institution, because we have to deploy their capital. We have to continue serving our communities as they continue to grow and expand.
Okay, well, talk about deploying capital. I know we have to go, but just a real quick question. The stock is trading below the IPO price. Your 1-year anniversary comes up in January. Have you thought about applying for an early buyback authorization?
You know, all I can tell you is that the Fed is not welcoming in those matters, and there's a built-in preference in the entire system to wait. And given the fact that we're pushing into October and there's only 3 months left before, you know, the 1-year anniversary, I think that, you know, it doesn't, you know, bode well for getting an early approval from the Fed that's only done it once in very narrow circumstances.
Okay, all right, well,
I
that's
mean,
fair.
people keep talking about the institution that was approved, but their approval was limited to buying shares for their ESOP plan in market, you know, not really to do the traditional buybacks that we're talking about.
Okay, well, then we'll be looking forward even more so to January. So, sounds good. Well, you guys, thank you so much. Thank you for joining us. We're
Thank
going
you.
Thank
to
you, Juliet and Ian. Thank you so
Well,
much.
we
Thank you so much.
really
Thank you.
appreciate it. Thank you.